Good afternoon, everyone. This is Victoria Rutherford from Adelaide Capital. Today we wanted to spend some time talking about what feels like Canada's most unloved sector, oil and gas. So despite the underperformance that we've seen, this still remains an important part of Canada's economy, if not the most important part, and also represents just under 15% of the TSX still, so cannot be totally ignored. With us today, we have Rafi Tahmazian, and we apologize for the delay. He had a little bit of trouble getting his mic going, but we're all set now. So if you don't know Rafi, he's a senior portfolio manager at Canoe Financial. He runs all of their energy funds, mutual funds, and hedge funds based out of Calgary. Over 28 years of experience within oil and gas, and he's going to take us through what's happened in the last few months, as well as how to invest in the space going forward. Before we get started, I just want to remind everyone that there's a Q&A box at the bottom of the screen. So if you do have a question, you can just type it in there. You can also email us at info@adcap.ca and we'll answer your question that way. With that, I'm going to turn it over to Rafi.
Great. Thank you, Vic. Appreciate the chance to speak. So yeah, we've had quite an interesting few months here in energy, pretty much unprecedented. And I'm going to try to speak to what we think happened and what we think we need to focus on going forward. But I think it's also very important that people understand how we look at oil and gas and the energy world in general through our kind of microscope, because I think it helps understand how we come up with our interpretation of what's important going forward. So many people look at energy like a subsector of multiple sectors in the exchange, and we look at energy like it's the exchange, and there are multiple subsectors within it. So we do take a very aggressive top-down approach about the market and energy and all the things that might affect it at a broad level. And we do also have attack it from the bottom up and assess companies and try to understand the businesses and what they're doing. But really, what we focus on the most is something in the middle, and that's the subsectors within energy. We break the sector into 9 parts, and it ranges in things like we split oil into conventional oil and unconventional oil. We have gas as its own subsector, energy services, the midstream sector, the downstream transportation. We have renewables and alternatives. We have we actually use cash as its own subsector as well. Sometimes the best place to be in energy is cash. So what we try to do is we try to pit all of these subsectors against each other. And you'd be shocked how sometimes someone might think they're invested in energy, and they might be in a part of the sector that isn't going to perform. In fact, might actually do quite poorly. You know, as an example, if you were positioned in the gas stocks a month ago, and you and the gas associated names, there are some of those names that are trading at year-to-date highs, actually, not year-to-date lows. So, and the theory behind that has to do with shutting in associated gas. We could get into that at some other time, but the point being, these oil stocks were collapsing, and if you were in the gas sector, you did quite well. And so that's why looking at these things and breaking the sector into small parts, I think, is very important. So I'm going to start here and talk a bit about how we think you should look at what happened. The first thing that developed probably was something that was developing since 2016, and that is that when OPEC and Russia started their partnership, there was an attempt by them to start to reduce managed production to manage the price of oil globally. And OPEC had been losing control of it, but felt like with Russia, they could get back control. What happened over the next 2.5 years is almost 3.5 million barrels of demand was generated in the market. We were up to about 101, 101.5 million barrels of demand in the world. And that 3.5 million barrels of demand, the supply that showed up for it was basically American shales. So to keep the price elevating, OPEC had to reduce production. Now, this isn't news to anybody here. We heard it before. But what I want people to think about is this cartel does not gain strength by cutting production to keep a price high. They gain strength by having to add production to keep a price from being too high. So they want to reduce it from, they wanted to have it in the opposite direction. Then they're gaining market share. In this case, they were losing market share. So the system on the supply side was already broken. And a lot of people will blame the virus. A lot of people will blame Russia. The system was broken because the U.S. was in a free market, adding production, and OPEC was trying to keep a price going by controlling it, by reducing their production. And all they were doing was really putting nails in their own coffin. Then along comes this virus, and it attacks the demand side. And it is an unprecedented attack of demand. And so in the meantime, this supply fiasco is going on. And what we feel is important is to separate the demand from the supply now. It is very important from a recovery perspective that we see demand start to work. And as recent as this weekend, we wrote up in our energy note that we think the next move is demand. In fact, we also believe the last 2 days of the market is demand. People encouraged that the people are going back into the offices, and across the North America, you've got governors and premiers talking about getting things going again. And that alone is stimulating the demand side and the expectations of it. So that's what we think is happening at this 10 seconds. And it's very important to monitor that. The supply is going to have to take care of itself separately. And we think it's very important that it rebalances. We call it rebalancing. And what we want to see is decimation of supply, really. We believe that Canada has sustainability, courtesy of being really having to be reverting back into a shell over the last 5 years. It was doing the opposite of what the US companies were doing. They were growing, expanding, building infrastructure, building production, and also building a lot of debt and and overhead. So these companies are about 4 years behind in the US to clean themselves up. And they've also, the predominant amount of that production is that high decline shale, which will be extremely vulnerable in this low price environment. So we think that there's going to be some decimation there. There's going to be amalgamation, bankruptcies, M&A. And the longer the prices stay down here, the better it is actually for Canadian oil and gas. Because what we want back is control of supply in OPEC's hands. And we want them having to add production to keep prices from getting too high. And that seems like a long ways away, but it doesn't happen without the building blocks today. So that's what we believe happened and how we think things are developing now. So let's look at supply here. How does it shrink? Well, first of all, I think it's important people also not separate, to give encouragement here. We are going to see shut-ins and production that's going to go offline and possibly not come back for a long time. But remember that there are these OPEC nations that are shutting in production, curtailments we'll call it. I don't think we should call them curtailments. I think we should call them shut-ins, no differently than what oil and gas producers are doing here. They are losing money too. It is an industry that is not free. It's extremely expensive. And so it's necessary to calculate into it the damage that's being done to these foreign oil producers as well down here. And that will affect supply negatively. And we can't quantify that yet, but I think that it's not only what's happening here, it's what's happening elsewhere. The other thing too is it's very important that people understand that you don't just turn a tap and turn the production on again. Very rarely is that the case. In fact, one small private co that I'm on the board of, we shut in basically all of our production a month ago, and we had to check with the bank and our lines to make sure that that there would be flexibility on the lines for us to restart our production at the point that we need to restart it. So there's a lot of complexity to just shutting in oil and bringing it back on again. Nothing's that easy. So supply is in the beginning of its rebalance, and so far we're very encouraged by that. What we would not want to see is some sustainable rally in oil north of $30 is the price that we think is the sustainable price, where we start to see that the supply won't roll off as quickly. So we want to see prices below 30. We think that below 30, it's really an inelastic situation. It doesn't matter whether oil is $5 or $25. It's a disaster. And it starts to rekindle a life above 30. Demand, how does it grow? So this is the one that is an intangible, and each of you get to make a decision on your own, really. It's a combination of things. It's obviously, when is the recovery going to start? What is the pace of that recovery going to be? It's funny, you can just say that like it's an easy question to answer, but that's probably the most complex answer that every person in business is facing today. What is the pace of the recovery going to be? Because I'm not going to rule out a depression, but I don't think we're going to see that. But I certainly see possibilities of a recession, and there's certain implications in terms of how that we recover and the demand recovers. I also see a very possibility for a moderate growth as well. There's been incredible, unprecedented stimulus from global governments. Annoyingly, it's almost to the point of being what we might refer to as a rights offering globally. And if it's just a rights offering, then all we've done is stimulate markets with a bunch of capital, but we really haven't stimulated the economy. And that could lead to a problem. So I could go around in circles here. I'm an economist, so I could keep talking for days on this, on that topic. But the bottom line is there's a lot to think about there in terms of how the economy will grow and recover. Then there's our human aspect. I want to say we are probably anywhere between, you remember I said we were at 101 million barrels of demand at the peak. We are probably sitting somewhere between 65 and 80 million barrels of demand right now. And on average for the year, it's not inconceivable to think that we are somewhere in the high 80s to 90 million barrels of demand for the year. And growth every year historically runs at about 1.3 million barrels. What is the growth in demand going to be? And we are going to be pulling oil out of storage for a while too. Now remember, storage is full, but storage doesn't get empty. Storage runs usually about 60%, 65%. So we've got to see 40% of that oil get pushed back into the market as well. And that's all going to affect how the demand numbers work too. So economy is important. How are we going to come back out? What are our driving habits going to be? There's a lot of people that say subways and buses aren't going to be as, people aren't going to be as happy. They're going to drive more. That's going to fuel the cars more. There's hesitance around going to big events. there's hesitance to fly, the pace of flight and growth, and people moving around. We are building our models on a very low recovery of demand. We don't see the benefit in trying to see be aggressive there. So we anticipate that demand will grow slowly in the conventional sense. And what do I say conventional? There's an unconventional part of demand that we don't know about. We're going to watch carefully too. What typically happens after major events like this, and I'll call them things like world wars or a major pandemic, is you see massive spending in infrastructure. We think there will be possibly massive medical and infrastructure spending, and more traditional infrastructure too. In China, the six biggest, most prolific provinces are, after the 2008 meltdown, cited $500 billion of infrastructure spending. They're citing over $3.5 trillion now. So this is all going to come using oil. We are not at a point where we can use alternative fuels for the needs and the pace of need of as some things like plastics even that are going to be required. So we are very we are encouraged that with the results, how the virus is flattening out. We don't have any opinion. We have to watch how we are going to react to the virus, and if there's going to be another cycle of it, and what happens in the fall if people start to have to go back to their homes again. Those are things you have to trade around, and you have to be managing that risk at the time. I can't be predicting it ahead of time. So it'd be very important to realize the things you have control of and the things you don't have control of, and what you're investing in. And it's never been more important than right now. So now let's talk quickly about Canada. I mentioned earlier, Canada, we went away from Canada for quite a while, from 2015 when Alberta elected an NDP government and the Liberal government was elected federally, and it definitely moved further left. It was a very obvious anti-energy movement in that government, and along with a lot of foreign nationals, we exited. In 2016, the U.S. elected a government that was pro-energy and wanted to deregulate, as opposed to we were increasing regulation and we were anti-energy. And so it elevated the opportunity there, and enormous amounts of capital flooded into that market. Also a lot of debt. And today that group is sitting burdened with massive debt, which means it's going to be very difficult for them to try to stimulate their growth again as well. Canada, on the other hand, is in much better shape, and there are significant haves in the sector, but there are many who are still struggling from the 2014-15 meltdown, and they're going to continue to struggle. So it is very important with stock picking to be very calculated in terms of who you're picking. In the very front end of a meltdown like this, it's not rocket science, it's flight to quality and liquidity. Over 60% of the index is two stocks, Suncor and CNRL. That's not a secret. That's the first place you hide. The key to trying to enjoy this market as it builds legs and quality, if the market is legitimate and not failing, is your transfer from these large liquids down into the large caps, then mid caps. And we don't typically get into the small caps ourselves. By the time you're registered into the mid caps, you're probably well into the energy cycle by that point. And then of course, as I mentioned before, don't forget, we think of things in a subsector strategy. And so you'll be looking at a lot of your transportation businesses, petrochemicals. As prices rise higher, that's when your renewables and alternatives are going to pay a lot more attention at that time as well. So Canada is a place to pick. It is, you have to be delicate in terms of the types of areas you want to focus on right now. As one example, we are positioned aggressively in the refiners. We've been that way since early last week, and that is just simply because, and you can't be in Canada with the refiners, otherwise you own the integrateds, and you're owning Husky as well, and I don't know if you want to own that name, but the direct integrated refiners out of the US you would own. If you think demand is going to rise and oil is going to go higher, the first thing that has to move is your refiners. So we piled in behind those. They've had a good trade here, and now the question is, do they have more legs, and will they lift the oil producers with them here? Just how much momentum does this market have? What kind of risk are you willing to take with your portfolio on that? And that's for each for his own. The other thing I wanted to mention on Canada, which is very topical right now, is government incentive. Our government has been extremely slow to react to virtually everything out there. Foreign governments are attacking their issues with liquidity, direct drive. Ours are using their own policy to benefit their claims, and I'm very worried about that. That's very disturbing for Canada. That is a risk that we carry with how this government is attacking it. The bottom line is that our industry needs liquidity. It needs flexibility on leverage, and I'm pretty comfortable to say, like, there is a proposal in front of them that they are offered to look at along with the Alberta government, and I think imminently we will figure out whether Alberta is going it alone. Hopefully they're going to go it, and whether the federal government will come along to backstop debt that the companies carry to the tune of anywhere between, let's call it, $5 to $15 billion. And it'll be access to the top 25 producers. There's some of them that won't need it. A company like CNRL won't access it because they have access to liquidity through banks all they want. And if you do access it, you're going to have to reduce your distribution to virtually zero and no buybacks. So there are a lot of them that won't use it. There are some that could use it and will benefit greatly, and there are others that will try to use it and probably won't be given access to it. So that's why stock picking also in Canada will be very important here. And some of the things we don't know yet in terms of how this incentive will look, if and when, who it's going to affect too. So that will give you an idea of the volatility in this market. I'm going to talk about one last thing, Vic, and that's something we used to talk about on the front end of our conversations, and that is energy unethical? And I'm just going to leave you with a couple of comments here. First of all, I think calling oil unethical is immature. Oil is not created equally. And what we all are is very addicted to oil, and we're going to be addicted for pretty much all of the people's lifetimes on this show, I'm sure. But what we have to realize is not all oil is created equal. And we have a movement afoot that is attacking the free world oil. And free world oil, which our oil is part of that, is part of the link to some of the oil that's produced in countries that have the highest human rights track records in the world. In fact, these oil producers, like ourselves, set standards for human rights. And that is the oil that is being attacked by these activists. The oil that is not being attacked because they can't attack it is the oil that's produced from dissident nations like Nigeria and Chad and Myanmar and Saudi. And ultimately, if they have their way, they're going to curtail production in the places with the highest human rights track record. And we are going to give all of our power of oil to these dissident nations. That's ridiculous. And I want people to think about that. Secondly, I'm going to ask people to look on YouTube and pull up an excellent documentary by Michael Moore that was released recently. And it's called Planet of the Humans. And I'm not going to say anything else other than that you shouldn't have your children watch it, because it has a bit of a, it's pretty thought-provoking and deep. But I highly recommend everybody take the time to take the hour and 40 minutes and watch this. And I think you will be pleasantly informed from it. So I'm going to leave it there, Vic, and if there are questions, I'm happy to take them.
Okay, great. Thanks, Rafi. So I'm just going to start with a few. I just want to remind everyone that there is a Q&A box at the bottom of your screen. So if you do have a question for Rafi, then you can just type it there. Okay, so Rafi, you talked about rebuilding the demand and what will the pace of growth be going forward. What are specific indicators or catalysts that you guys would be watching to get more confidence that demand is rebuilding?
There are early indicators. So the ones that are occurring today are the flattening of the curve on the virus, and governments starting to say they want to get people back into the offices. Those are the very early indicators. But the material, tangible ones are going to be we watch congestion, traffic congestion, and air traffic carefully. It's not hard to do. There's a lot of people who send it to you as well, and so we're trying to monitor that too, and watch it. Just be conscious that the powers to be have made us very concerned about that. If we elevate that, do we roll off again and get ourselves to a point where the virus comes back? And that's a risk we're going to be taking. This market is going to be volatile, and you have to invest accordingly, and we have to invest defensively as a result of that. But really, the first phase has happened. The desire to see the flattening of the curve, the economy's growing will require us to watch congestion levels of traffic. It's about transportation, basically.
Okay, this one is from the audience. It's more on the supply side. So the information that comes out of OPEC seems so unreliable, and countries continually ignore OPEC rules. How do you make sense of the energy price despite this?
Well, again, they are all independent producers now. These OPEC nations are bleeding debt and cost, and so many of them are in dire straits. And I don't think it'll be very easy for them to be for them to recover either out of this. But we can monitor the production at the end of a month quite clearly. So what they're going to do and what we can see they've done after helps. But I think the group is a lot more aligned today. If they want to rebuild OPEC and get back to the point where they're in control, they're going to have to be diligent. And I'm assuming you're referring to how they used to cheat in the past on their production. I just don't think that is something that I see as a risk.
Okay. In Canada specifically, so given the liquidity issues that some of the smaller companies or mid-sized companies are having, it's been long talked about that M&A is needed in the space. Do you think this will be a catalyst to finally start that process?
I would tell you that the meltdown in 15 was a catalyst. And between 15 and today, 2020, it was disenchanting how little was done in consolidation. I think it's a necessary evil now, and I'm intimately involved in some, and can tell you that parties are starting to accept. Boards are starting to act more independent from management teams. Management teams are starting to accept that life is not going to be the same anymore. I think that I've had some discussions with journalists about the idea that we have to start maybe looking at the Canadian energy sector. We used to be an exploration basin, then we used to have what we called an exploitation basin. Now, really, it's a manufacturing industry, and it's not about growth and models or anything. It's about driving costs down and producing a widget. In this case, a barrel of oil, and this widget doesn't depreciate; it depletes, and that's why it's important that the longevity of it. Why the longevity of it will be there, because it's not a depreciating asset; it's a depleting asset. but we have to start to act more like manufacturers. And if we're going to act like manufacturers, then you're going to see that your small cap is no longer what you used to call them. A small cap is maybe a 25,000 barrel a day company, not a 5,000 barrel a day company. And that's going to require massive amalgamation. And I think that's coming, absolutely.
Okay, I'm going to flip back to some audience questions. Are you holding much cash? And if so, what catalyst do you need to see to deploy it?
So when we took on that gas trade about a month ago, and there was this push to bring OPEC and Russia and the U.S. together and kumbaya and cut production. I called it GlobePec. We just shook our heads and said that's a disaster waiting to happen. So we took our oil positions, and into that rally, we built cash to almost 30%. As the market started to correct, I was hoping it would correct further, deeper. We did start to deploy that money back again, and we sit on high single digits cash now, probably 8 or 9%. Obviously, on a day like today, I wish I was fully invested, but you're never going to be able to beat the index when 60% of it's two stocks that are up 10% today, and you're only allowed to have 10% of a position in those things at any one time. So our index is very deceiving that way. But I think, another way to answer that question is, am I going to take profit in this rally? And I don't think this is a fundamental move yet. I think there are going to be a lot of hiccups still, but I also think there's a significant ceiling on oil through supply still that'll keep it below that $30 price, which will help us rebuild, rebalance. It'll help us force these amalgamations to happen.
Okay. Why are the Canadian oil stocks, or why have the Canadian oil stocks not fallen more, considering their break-even cost is substantially higher than the current WCS price?
Man, how much further do you want them to fall? There are quite a large amount of the industry is trading on its debt value now. In other words, their equity value is virtually gone. So don't be deceived by that. But the larger integrated producers still have value assets that are hard assets. The producers still have a resource in the ground. That government incentive program, we think, will probably be used, and they will use those resources as their security from those companies until they pay them back as well. So it's just, that's why I said it was inelastic below $30. These companies are all negative cash flow. There is no value that you can calculate tangibly. That's why a person that's trying to model this stuff is probably pulling their hair out. This sector, investing in it today, has become touchy-feely, if you will, because the market is touchy-feely today. I know that's a weak answer, but I apologize, but that's really what it boils down to. It's just far more philosophical today than it is using tangible numbers.
Okay, so another question along those lines. What is the true break-even price for Canadian oil sands production? And assuming that we don't see a V-shaped recovery, do we think that the oil sands producers will continue to produce despite lack of profitability?
Yeah, it's not a homogeneous industry. They don't produce the same way. Some are more expensive than others, blah, blah, blah. So, I mean, it's not as easy to shut in steam-assisted gravity oil sands production. It's very expensive to bring it back on again. It takes a lot of time. So you have to try to anticipate how long price is going to be down and weather it. And they're in that mode right now. But that industry has a very low declining asset. And that's why it's going to be sustainable for the long term. But oil prices need to be, I think your rule of thumb should be that the group needs to see $45 oil, WTI, and then the more traditional differential for their oil up here. The pipelines that are proposed to be built and are being built are going to also help alleviate the differential issue that we're having, these massive swings, which is going to ultimately help us with getting capital back into our sector. The federal government is a deterrent for getting capital back, but the pipelines were a big part of that. We've found a way to get around all that. We're slowly inching our way into the global market with our oil, and that'll help us with the differential. But really think about oil like at $45, you're starting to see these things, cash flow through into earnings as a general rule of thumb. And don't think that they shut in just whenever they like. It's a very difficult process for them to do. So that means they carry the burden of losses in this period at a greater pace, and you have to take that into account when you make your investments for sure.
Okay, so then just on the pipelines theme, since you mentioned it, so given everything that we just discussed with demand destruction, does Canada still need new pipelines, or has this issue been addressed by producers cutting how much they supply?
I think that Canada's oil production of approximately 4 million barrels is a very sustainable production, a production that is, for the most part, should be globally economic. Beyond that, do I think that our high declining shale producers, and I would say high declining meaning north of maybe the high 30s and low 40% decline rate average type production is as an average is not going to be something in the future. I think that we should expect to see 80 to 90% of Canadian production recovery at a minimum. I hope to see something significantly less than that in the US, where they see, I think, I'm guessing here, I should know the number exactly, but I think peak production was close to 14 million barrels, of which I want to say 9 to 10 million of those barrels are higher declining shale production. That they have a far higher vulnerability. They are the target of both that production that they were already producing and being, if you will, decapitated from their ability to grow production again. If they could sustain the industry that sustains their production at 12, 13 million barrels, and we sustain ours at 4 million barrels, not growing it all the time, we can be in an environment where we're focused on costs and profitability based on the price and the market you market it to. I think there's a real chance the market could recover nicely. We just don't know how. And I think I don't think it can happen that way, but I don't think the U.S. has cash flow or access to capital to be able to grow their production anyway. So I'm more worried. I'm more interested in seeing the U.S. destruction of their production than ours. And I think ours has more resiliency.
Okay. Also, what do you think of the pipelines and midstream companies right now? And specifically, what are your thoughts on Pembina?
The pipes are the pipes. They're probably your safest bet. They're the last point of fear around your income that you achieve. It's pretty benign stuff. Your midstreams are the ones that are more volatile and more susceptible to parties, third-party processing, and will those parties participate and be there to pay you or deliver their products to you when per their contracts. Pembina, based on how we view risk of all of the group, we risk 20% of their production contracts relative to the stuff that we think is will be in place versus the stuff that is the volatility. And I would say that government incentive I mentioned earlier, that would read through very well for those midstreams like Keyera and Pembina, because it would ultimately mean the producers are getting strength to be able to fulfill their contracts. So look for that to happen to help you bolster that.
Okay, and then can we just talk about dividends in the sector for a moment? So do you think the dividend model is going to be dead going forward? And then especially too in some of the large caps like Suncor, who have paid long-standing dividends and have a track record for some time?
My wish is that dividends become a big part of the sector, actually. Per my comment earlier, that I want the sector to be not a growth sector, spending multiples of cash flow anymore, which was certainly my DNA from the industry too. More, this industry has matured dramatically, and we are a manufacturing business, and we should be driving costs down, being more focused on marketing the product, being mindful of what's going on with the products that we sell around the world, anywhere from gas to all the liquids and the different products. Remember, we have the heavy oil that the refiners need. The U.S. produces a lot of lighter, sweeter oil. So our oil, there's a lot of demand for that oil. So I think that's, I expect the dividends to be something that I will be attracted to, and I'll be monitoring who is able to create a dividend and what purposes they're doing that for. You know, because growth is just not necessary now. Let the price decide if we're going to grow, and that means we need to see a much more higher price and an economy that can survive in that price before we start to think about growing production. And I'd rather than be focused on driving costs down and dividending that out to me. A company like CNRL, that I spend a lot more time on their dividend than I do with Suncor, because I don't really want to play those things because they're the index and I want to beat the index. But CNRL, you can't ignore. It's the largest gas producer in the country too, and you've got a company that has a lot of flexibility for periods of time to keep their dividend going at the pace it is, because banks will give them liquidity all they want. But they trade at, or they traded at, I guess on the weekend, last time I looked at the yield, at almost 9%. And that company, in a more normalized world, you would expect it to trade more in the 3 to 3.5% yield. That would imply that that stock has a over 100% return in it. Okay, one of the most conservative names in the industry on a production basis, the largest producers in Canada and largest companies in Canada, and I'm talking about in good conscience telling you that there could be over 100% return in that's almost irresponsible on my part, but that's what's happened to these companies. The lowest risk names in the industry have literally 100% return in them in a full cycle. And that means if you move down into the higher risk names, into the large caps and the intermediates, then it's not inconceivable to think in a full cycle that a 300 to 500% investment return is possible. It sounds irresponsible for someone in my place to be saying that, but I don't have a problem saying that right now.
Okay, so that actually segues well into this next question. So a comment that I hear a lot from people who are looking at the space is, at these levels, why don't you just buy C&Q and call it a day? Is there a point in investing in anything else? So maybe if you could just elaborate your thoughts on that.
Yeah, so per my comment earlier too, CNRL will have flight to quality and liquidity. That's one of the names that will get a lot of the action. And as the cycle starts to build, and if we are into truly an energy cycle, then the opportunities for returns will start to diminish on CNRL, and the market will gravitate to more risk. That's just risk management. And so our job is to try to be ahead of the slowdown on the curve on a name like CNRL and move into the intermediates producers like the Tourmalines of the world, or the Paramounts, or ARC, and the oil producers. Like the risk that you carry owning MEG today versus the risk you might take with it, knowing the energy cycle has got legs on it, you might have a more robust position in a name like MEG later in the cycle. And if you transition correctly early enough out of the ones that are flattening on their curve, that's how you create your 300 to 500% return, because the CNRL probably has 150% return in it. But so that's what you're trying to achieve here, is grabbing the growth in the market and trying to step ahead of it as it grows in an energy cycle. But you need an energy cycle for that to occur.
Okay, two quick questions focused on the large caps. Could you see one of the Canadian large caps graduate to be a super major?
Yeah, there's only one that can do it, and that's CNRL.
Okay.
I mean, I would love to see that, but you know, that's a big step when you start getting into, you know, the super majors are in the petrochemicals business. The super majors basically developed the LNG business. Those are big dollars and a big reformulation of the business. But I don't see it right now, but that's the only one that would have a hope of doing it.
Okay, and then secondly, would Cenovus ever sell its refining assets to improve its balance sheet, in your view?
Yeah, I mean, that's not what they would want to do. I think integration is very important for the integrateds. You know, I'm a fan of these producers selling their infrastructure. I'm on the board of Topaz, which is an infrastructure fund that was spun out from Tourmaline, and I think that that is going to be a very prolific business as these producers use that as a vehicle to reduce their debt. I don't think Cenovus wants to get rid of their refining. I think it's a very important balance for them. So other vehicles to reduce their debt is what I would hope to see from them.
Can we talk for a few minutes about hedging in the space? So are there players that still have hedging contracts or have a lot of them rolled off? And also, are there any issuers you like who have hedged well above current prices? And is there a level where you would want companies to start hedging their production again?
Well, you're going to start to see gas hedging if gas goes much higher here. If you start seeing it closer to $3, you'll see the hedging on that. And that'll put a cap on the ceiling on the price as well. I don't think there's any hedging going on in the producers here of oil. And the ones who have oil hedges have already really laid those out to the market, and the market is reflected those hedges into the stock prices in terms of what their real leverage is. So the market might crystallize their hedge in their mind by reducing their debt by the gain that they would have based on the expected price that investor has for the rest of the year. And the differential is the price that they benefit. Some will crystallize those gains too. Really, it's all, the market's very efficient and figures that stuff out. But, you know, we're now 2 months into the correction. By mid-year, you start to see some of the vast majority of the big bulk of your hedges start to come off. By the end of this year, you know, companies don't hedge out much beyond a year. It starts to drop off dramatically. So a sustained lower oil price down here, these companies are all more vulnerable and start to get hurt by this. But it bought a lot of those companies time to fix their businesses. So when the hedges roll off and if oil prices are still low, their businesses are much different at that point than they were when they put those hedges on. Hopefully, that's what you got to see too. Very complex for sure, and how hedges trickle into the whole infrastructure of how the company works, operates.
Okay, sorry, I just want to make sure I understand this question properly. So they're asking about, given the gearing for US producers, is M&A a real possibility, or will a lot of high cost assets end up in the hands of their creditors or financial buyers? If financial buyers are emerging, looking at Canadian companies, do we still have substantial non-core assets that they could sell?
There's no foreign money coming to Canada right now. Like, we look like the plague. We are a socialist country, and our government is increasing regulation. The regulations are confusing, and so there is really a lack of confidence in putting capital into Canada. So what is happening here in the amalgamation and consolidation is going to have to happen within our own. I don't think you'll see a lot of aggressive investing, foreign investment in Canada, other than opportunistic trading type people, which kind of what we're doing right now, but not the kind of capital we typically historically have seen. But I do expect to see consolidation, and I'm sure the banks do not want to inherit these assets, so they will try to keep these things alive as long as possible, which is all the more reason why the ones that need a lifeline from the bank, fine, but the ones that don't, it'd be a shame if government doesn't step in here to give them a bit of reprieve, to keep them able to participate when this market does recover.
Okay, so there are some ESG funds that are now investing in energy names that are focusing on reducing their carbon footprint. Do you have any favorites on that front?
I will tell you with comfort that the whole industry in Canada has been regulated for so long with strict regulations. Our entire industry is really operated under the auspice of this ESG already. We started a water management business 2 years ago with the purpose of introducing the water management in oil and gas that Canada has been doing for based on regulations for 20 years, and introducing that to the U.S. And so we took a business from Canada down into the Permian, and it's leading up until this meltdown, we were really revolutionizing how water management is done down there, because they don't recycle and they don't treat water the way we do. And our industry, it's just commonplace the way we do it that way. Our reclamation and how we reclaim sites is commonplace. How we transport products and our HSE history is the best in the world already. So to start to differentiate who's doing more or less, I almost feel like it tells you I would be very cautious of the ESG fund and what it's doing. All they're really doing is just investing in the energy sector in Canada, because the whole sector operates at a very high level of quality relative to the rest of the world. When I mentioned earlier about ethics of oil, and I talked about not all oil is created equal, and I talked about human rights should be an issue in terms of where you buy your oil. You should also buy your oil from countries that have high standards, environmental standards. And I have absolutely no problem putting Canada up against every barrel in the world that's produced that we will qualify as some of the very highest standards. So highest human rights standards, highest energy, environmental standards. This oil should be the last barrel of oil produced in the world.
Okay, so this is the last question. So if anyone else has any further questions, you can type them at the bottom of the screen in the Q&A box. Rafi, so innovation is rarely discussed in the energy sector. Will tech advantages or development play a role in which firms will win longer term?
Well, tech was instrumental in creating the shale play 10 years ago, and the oil boom that probably brought 15 million barrels of production to the world. So tech is very important and is constantly being used here. The problem today is tech tends to happen in a more robust environment, and so it's something that you'll see will slow down here, because the producers are just trying to keep their heads above water, and it has to be a very compelling opportunity for tech to be used. And think about the speculative capital that's associated with the front end of tech, and then think about the world we're in today. and the world of hurt that Calgary's in, and the energy industry in Canada, and just that capital is not available right now. So it's going to be slow for a bit, but it will rebuild, and it is the future for our industry.
Okay. So those are all of the questions. Do you have any final thoughts that you just want to leave everyone with?
No, I think maybe one final thought here I should end with that Michael Moore documentary. You know, that again, take the time and watch it. And what I want people to understand is there is no solution to the fossil fuel issue we have. And I think that saying that we have a fossil fuel issue is also important to admit. What it boils down to really is the pace of our population growth and our pace of accelerating our lives and our usage of goods and services in the world is not sustainable. We can't keep growing. And everybody needs to start to realize that it's actually going to boil down, if we're going to survive, it's going to boil down to each of us looking in a mirror and saying, what is my footprint? And how can I reduce my footprint? That's what is going to make the difference here. So I hope everybody takes the time and reads and watches that show, and think about what I just said there too as well. Thank you, Vic. I appreciate the time.
Yeah, thank you so much for coming on. We love having you. And if anyone has any follow-up questions for Rafi, just email us and we can get them over to him for you. So info@adcap.ca. Okay, thanks again, Rafi.
Cheers. Bye-bye.